Hello everyone, I am Divya Grover, here to help you take informed mutual fund investment decisions. Diversification, as you may know, is the cornerstone of successful investing. A well-diversified portfolio of mutual funds allows investors to minimize the risk to their portfolio and earn optimal risk-adjusted returns. But what exactly is meant by a well-diversified portfolio? Many investors often question whether they are holding the right number of mutual funds in their portfolio to achieve their financial goals. The general assumption amongst investors is that if they keep adding popular, star-rated funds to the portfolio or add newly launched funds, their portfolio will be well diversified and in a better position to deal with market volatility. By doing so, investors often end up accumulating 15 to 20 mutual funds or more in their portfolio. So, is it a good idea to keep adding new mutual fund schemes to the investment portfolio to earn better risk adjusted returns and minimize the risk? Well, the answer is no, because as the saying goes, too much of anything is good for nothing. In other words, investors should avoid over diversification of the portfolio. Adding too many similar schemes in the portfolio leads to over diversification, which is counterproductive to creating wealth. When one holds a plethora of similar categories of mutual fund schemes, it can cause more harm than good. Surely it will provide you with a little bit of everything, but not enough of anything. This is because mutual fund schemes within a category hold more or less the same set of stocks in their portfolio. So when an investor invests in two or more schemes within a category, it is likely that they have invested in the same set of stocks, albeit in varying exposures in their portfolio. This results in mutual fund overlap. Holding too many similar schemes can expose the portfolio to concentration risk, leading to polarized returns as it will be skewed towards a few set of stocks, sectors, market cap or investment styles. As a result, while it gives the impression of diversification, it may not help achieve the intended objective, that is, minimize the risk during volatile market conditions and earn better risk-adjusted returns in the long run. To achieve the intended objective as highlighted, it is advisable and makes better sense to add assets and mutual fund schemes wherein there is low correlation with one another, so the risk is reduced. Likewise, it is also crucial that investors avoid concentrating their investment to a particular fund house. At times, two or more schemes belonging to the same fund house may also share stark similarities with one another, even though they may belong to different subcategories. This may happen because the schemes may be managed by the same fund manager, and thus the investment philosophy, style or strategies applied in the stock selection process may be similar. In such a case, if an investor has exposure to two or more schemes within the same fund house, it is likely that the schemes will mirror each other in terms of outperformance and underperformance cycle. So, instead of owning multiple funds within a category or fund house or investment style, one should carefully analyze the composition of the portfolio and then make informed decisions. How many funds you should hold in the portfolio will depend on several factors such as your broader investment objective, risk profile, the financial goals, and the investment time horizon before the goals realize. Thereafter, depending on the needs and investable surplus, individuals need to build the portfolio across subcategories, categories, and investment styles to achieve optimal diversification. For an investor with a small portfolio size of say around 2 to 3 lakhs, 3 to 4 funds may be enough for adequate diversification, while for an investor with a large portfolio size, 7 to 8 or a maximum of 10 funds may be sufficient. So what if you hold too many mutual fund schemes? Well, if you are holding too many schemes, here are some helpful ways to reduce the number of mutual fund schemes in the portfolio. Number 1 is to redeem schemes that do not align with your financial goals. Many investors keep adding mutual fund schemes to their portfolios, either driven by emotions or influenced by peers, family, or by the popularity of the fund house, its star ratings, or the top performers of the recent past, hoping that it will help the portfolio deal with volatility. However, such investment may not always align with your risk profile, financial goals, or overall asset allocation plan. If you clearly define your financial goals, investment horizon, and risk profile, it will help you create a focused and goal-oriented portfolio. Number 2 is to remove schemes with overlapping investments. If you hold multiple schemes within the same category, it is likely that they have invested in the same set of stocks with similar strategies, in which case it will not add much value to the portfolio. For instance, if an investor owns 3 to 4 large cap funds, it is unlikely that all of them will turn out to be outperformers, and they may end up earning returns in line with the market. The higher gains in one or two schemes may get nullified by lower returns in other schemes. So, consider adding more schemes within the same category only if they follow distinct investment styles or strategies. Number 3 is to eliminate consistent underperformers. Consistent underperformance of a mutual fund scheme relative to the category peers and the benchmark is an important signal for you to consider moving out of it. The scheme that one has invested in should be capable of limiting the downside risk during bearish phases by falling less than the market and the peers, and generating higher returns than the market as well as the peers during bull phases. However, avoid judging the schemes based solely on its short-term performance of say 6 months, 1 year, etc. Also avoid comparing the performance with a scheme belonging to another category. In conclusion, adding too many mutual fund schemes to the portfolio can make the crucial task of monitoring your portfolio a challenging exercise. You may even end up with a portfolio consisting of underperforming schemes, schemes with overlapping investments, or an unsuitable asset mix. Therefore, include only those schemes in the mutual fund portfolio that aligns with your financial goals and personalized asset allocation plan. For more guidance on mutual fund investments, subscribe to Equitymaster's YouTube channel. If you like this video, please give a thumbs up and share it with your friends and relatives. Signing off for now. Happy investing. Mutual fund investments are subject to market risk. Read all scheme related documents carefully. Registration granted by SEBI, membership of BASL, and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors. Investment in securities market are subject to market risk. Read all the related documents carefully before investing.